Yeah, I thought you loved learning, and I thought you loved moi. All right, so let's try to get through this quick, since I gotta speak at a thing up there at 10. No, I'm speaking with Dr. Lawhorn and Mr. Crockett. Sure, come on down. If you want to learn about the outcomes of our portfolio assessment project 5 years in, you come. That'll be awesome. All right. So the last two chapters are about decision making, which is like using this financial data that we've been talking about for a year now between accounting 1 and accounting 2 for decision making. This chapter is short-term decision making, and the next chapter is more like strategic or long-term decision making. So that's what we're about. Let's see. Let's see if I can get this thing to work. All right. So an important concept in these chapters is the differentiation between relevant information and non-relevant information. I know that sounds obvious that you wouldn't use things that were irrelevant in your decision making, but with financial data at times that can become muddy, this decision as to whether or not this is relevant. So we'll talk about some of the things that define whether or not something is relevant. So the biggest one that people often screw up on are something called sunk costs. That means money that you've spent in the past and that you cannot change going forward. So it'll go something like this. You'll go to the owner of the business and you'll say, you really need to get out of this segment of your business. And they'll say, but I spent like $100,000 on that equipment. To which your reply as an accountant should be irrelevant. They don't like that, by the way. And you tell them that their $100,000 is irrelevant. But here's why it's irrelevant. Because if I spend $100,000 on some equipment to start another division for my business, and that division's losing me money, the fact that I spent $100,000 last year on that equipment shouldn't impact the going forward decision at all. The only thing that should impact the decision going forward is, can I start to make money or not? And if the answer is no, then better to get rid of the equipment. Maybe you can get some money out of it now while it's relatively new. So the price you could sell the equipment for, that's a relevant issue, right? Because that impacts the going forward. What you've done in the past is a sunk cost, and it's irrelevant from a financial standpoint. A lot of times with consulting, you have to tell people, you have to help people understand the difference between irrelevant from a financial standpoint and irrelevant from an emotional standpoint. The fact that you spent 100 grand is very relevant to you emotionally, but just because you spent 100 grand isn't a good reason to continue making a poor business decision. That just loses you more money. So sunk cost is a biggie. Depreciation, purchases are the original purchase price of an asset, irrelevant because they don't change things going forward. Also, non-financial or qualitative factors, those are irrelevant from a financial or a fiscal standpoint. It doesn't mean that they're not relevant emotionally, okay? Again, there's a big trap. We've fallen into it here at the college right now where, has anybody ever gone to the store and seen something on sale? Something that they would not have purchased otherwise. But because it's on sale, you decide you got to have it. And then you rationalize it by saying, I'm saving money by buying this, right? But you're not really saving money, because if you wouldn't have bought it at all, then you would have spent no money. That would have saved the most. So getting something you weren't going to purchase in the first place at half price still costs you money, okay? In business, or like here at the college, what will happen is our grants guy will look out there and he'll see this grant available to the college. And most grants are what's called matching funds grants, meaning if you pay a certain amount of money, they'll pay another amount. So like right now we have this program called Gear Up, That's an example, or the Small Business Development Center. So if we wanted to have a program here at the college that helped local businesses be strengthened and improve their chances of survival and help them through the process of financing, if we were going to do that, we were going to pay for it all ourselves, and then we could go get this grant that would pay half of it, well, that'd be a really great deal because we were going to pay for the whole thing, but now we're getting it half off, so to speak. But if we were never going to have that program, and the only reason we started that program is so we could get the grant, which only paid for half of it, now we're spending 50% of what we weren't going to spend at all, and that's a net negative to cash flow. Does that make sense? So these qualitative factors, how do we feel about it, and is this a good thing? Well, those are important in decision making, but they're not financial factors of decision making. And so a lot of times the finance guy or the managerial accountant's job, it really is to be like the heartless person who just says, like, let's look at this in financial terms. I found it's very helpful to people to say, I know that you're emotionally invested in this, but I'm going to work up some financial statements that are going to show exactly what the financial part is. And if after looking at those, you say it's worth it to me to spend an extra $20,000 to have this, then that's great. That's your decision. You're the owner. You're the manager. But a lot of times people are blind to the financial side and they just let the emotional side run them. So that's what this sort of short-term decision making is about. So what we do is something called differential analysis. And that is just where we look at those factors in a decision that would be different between the different decisions. Instead of, so in essence, you don't have to compare things that aren't going to change. You can just throw those out and just look at the differences. That's differential analysis. And so this chapter is going to cover the type of problems you're going to see are, do we put a special price on this product, or do we keep our regular pricing? Is it worth it to give a special price if it might change our volume or something like that? Okay. Do we drop this unprofitable product line or segment? How do we adjust our sales mix? Should we be pushing this product more than that product? And then the idea of outsourcing. Do we hire this out to a third-party firm, or do we continue to do it? A lot of times firms are really good at what they do, and they know they can make more money if they would process something further, but they're not sure if it's best for them to do that. A good example would be like the Vlasic Pickle Company. So they have a really good recipe that people like for taking cucumbers and pickling them, right? I mean, that's what they do. And for a long time, they just sold pickles. Well, they started discovering that there was more profit in further processed pickles, slices for hamburgers, relish, those sorts of things. Then you could sell, 8 ounces of pickles for the same price of a big gallon jar of whole pickles. And so there's a better margin in further processed goods. So the question they had to decide at that point was, do we change our, add the equipment and everything we have to do to further process our product, or do we sell our whole pickles to a processing company who will then process them and put it out under their label, or do we find a third party who maybe will do it under our label and we contract with them for the process of further for further processing? Any of those decisions may have been the best one. Well, there's a financial side to that, right? The costs of each of those decisions. So here's the big 3 questions when we're setting prices. So we're going to go into the pricing. First of all, what's our target profit? How much money do we have to make off of this? Okay. Number 2, how much will customers pay? You might want to make a target profit of 10%, but if customers are only willing to pay at this level that's only going to make you 5%, then what do? Right? You either try to change your marketing function to make people willing to pay a premium for your product, or you reduce your costs, because sometimes there's only a certain price the market will bear. And third, is the company a price taker or a price setter for this product or service? In other words, do I have to follow kind of what the rest of the market's doing, or can I be the person who blazes the trail? And I've seen a lot of times where people get that wrong. Either they think that they have to match everybody out there, or the other way around, when they should be matching everybody out there, they think that everybody will pay a premium for my product and nobody cares, right? All right, so that question of am I a price taker or a price setter? A price taker has little control over pricing. It means you just have to kind of look at the market, see what normal prices are, and then set your prices accordingly. A price setter is one who has control, more control over the pricing. let's see. So price takers typically have a product that is similar to the rest of the markets and isn't really differentiated in any way, okay? Whereas a price setter tends to have a more unique product or a product that really is somehow superior to the other products on the market or different in some way, differentiated in some way. All right. So for price takers, they focus on something called target pricing. That means we set the market, we set our price based on the market price somewhere in there. We don't have to be the highest or the lowest, but we find some place in there and we set that first. You set the price first and then you adjust your costs and everything to sort of make a profit off of that price. Because you can't control the price, you have to say this is the price I can sell for, so then I'll have to control my costs in order to still make a profit at this price. Does that make sense? As opposed to a price setter who can say, what target profit am I looking for? And I will set my price based on my target profit. So there's two scenarios. One where you start with price and then have to adjust what you do to still make a profit with that price. The other where you start with profit and set your price to that. All right. Why is this not showing any of the pictures? That's why this is looking so weird. Let me see something here. All right. That's why the whole thing on price takers and price setters is confusing, because there was no picture there. That's weird. But that's who they are, so we'll move forward. So when we do target pricing, what we're saying is we need our revenue minus desired profit is our target price. So here's our budgeted income statement. We know that we need a revenue of $1,200,000. Well, then that's going to drive, because we're going to go, what's our volume going to be, right? And we multiply that by what our target price is. So when we set our prices, we have to cover all of our costs and make some sort of desired profit, right? So if our desired profit is $250,000, then that helps us set our target price. That's all. It's not that hard. I mean, this chapter shouldn't be too bad, guys. So when you start looking at what the market's going to do, you can say, well, either we can price it exactly at our competitors and accept a lower operating income, or we can reduce our fixed costs, or we can reduce our variable costs. Whereas if we're a price setter, we can say we can just set our price a little higher and not have to reduce those costs. Again, it depends on the nature of your product and the nature of the market and how competitive you are and what you can do with it. So there's our other, we'll try to increase our sales volume or change this product mix, which we'll talk about more later. This is more marketing efforts, right? Differentiate the tablet from the competition. And then I like 7, or a combination of the above strategies. So the reason I like this sort of stuff is this is more what I like to do. So this is more of the real life, the stuff that I was good at before I just started becoming a teacher and like stopped being good at anything. No, just kidding. Yeah. Like, oh, you're a teacher. That means you have no actual skills. You're just really good at telling people about stuff. And so if you think about it, like even here at the college, we are going to have to make some differences, some changes, right? So that the financial situation in the college gets stronger, because it's gotten weaker over the last several years as the state funding has dried up. And so we have to sort of look at all of these things. What's our product mix? Which products make us money and which products lose us money? That might mean subjects that we teach. Are there some that are more expensive than others? If they are more expensive, are they worth it? Nursing is a good example of a program that costs way more to run than most of our other programs. Is it worth it? Probably, because students who leave here with nursing degrees can go right into the work field and make good money. What a lot of other colleges have done is they've put special fees on nursing classes. So it costs more than the regular tuition for other programs. And so why have they done that? Because they said, well, we don't want to get rid of the program. It's a good program, but it's an expensive program. So students who do this are going to pay more. Okay. But colleges don't think that way, right? They don't think of the subjects they offer as a product mix. Traditionally, they've been funded primarily by the state, so they just sort of offer classes and try to find the ones that students like and try to find new programs that students will like, instead of saying maybe certain programs, because of their potential to put people straight into the workforce making $50,000 a year, as opposed to like business where you're still going to have to go get a bachelor's and probably a master's, maybe that one that can put you straight into the workforce should be priced at a premium to the others, or something like that. So those are things that we're having to start to look at as a college, as there's less state money and we have to think more like a business. So cost plus pricing is the other side. So price setters, in essence, will take their product cost, add in their desired profit, and that gives them their price. So we take our variable cost plus our fixed cost, that's our full product cost, our desired profit. This company, they say their desired profit is 10% of their average assets. So $250,000 desired profit gives them a target revenue of $1.214 million. Divide that by the number of units you expect to sell, and that gives you a cost plus price per unit. Okay. So again, the two different strategies are, one starts with price and builds from there. The other starts with costs and builds from there. I don't know why they needed a flow chart for that decision process. If it's a price taker, you go to target pricing. If it's a price setter, you go to cost plus pricing. Thank you for that flow chart. All right. I don't know. It seems like I don't know. That's the problem with using the publisher's PowerPoint. Sometimes you're like, I should have taken that one out. All right. Special pricing. So sometimes you get customers who want like a special order. I want you to do a volume order. Did that ever happen at Mechie's where someone calls and it's like, we're doing a party and we want 8,000 tamales? And we think that you should sell them to us at 10 cents a piece because we're buying so many. And you're like, well, I've still got to cover my costs, right? So this is the idea. Special pricing. You have to consider, does the company have the capacity available? In other words, do I have to, in essence, stop producing what I regularly produce in order to do this? Because that's going to change what it costs me. But if I can fit it into my regular capacity, that's money saved, right? Will the reduced sales price be high enough to cover the differential costs of filling the order? So if I give you a special price, but that lower price times the volume, will that be enough to still make money on the deal? And will the special order affect regular sales in the long run? If I start doing these big bulk orders here, is that going to affect people buying it elsewhere? Yeah, that could be in a positive way or a negative way. Maybe if I'm Mechie's and I support parties and people say, hey, where'd you get this food? It's awesome. Then it'll create more customers, right? Or maybe my regular customers will be like, I just had Mechie's at that party. I'm not going to go out this week. So those are things to consider. And as you can imagine, some of these things are easier to estimate and others are quite hard. To know how this decision is going to impact future sales is not always easy. All right. So there's our budgeted income statement. In a traditional format, revenue, cost of goods sold, gross profit, expenses, operating income. And in a contribution format, revenue, variable costs, contribution margin, fixed costs, operating income. Yeah. Uh-huh.
But like with the school, which would be at the price setter or taker?
EAC?
Yeah.
We're probably a taker in the sense that we've got to look at what other community colleges charge and be in that relevant range. We can't really premium price our product way above.
Okay, and then so like if we're trying to take it like that, how does the school give us something like full-ride scholarships and stuff like that? Like how do they benefit?
Well, so again, this is a vestige of the past. In the past, our revenue was made up of taxes, property tax, what's called FTSE, full-time student enrollment, which is what the state government pays, plus something called equalization, which is something the state government pays us because we're in a rural community that doesn't have a big tax base, so they pay us more than like Maricopa would get, plus tuition. So at one point, FTSE was not capped. In other words, the more students you had in chairs, the more money you were getting from the state. And that was actually the bulk of our revenue. So we could scholarship you and still make enough on the FTSE payment to kind of cover our cost, almost like a break even if someone was at scholarship. What happened though is the governor at some point when money ran tight said whatever FTSE level you're at right now, full-time student enrollment level, that's your cap. You'll never earn more than that. So if your enrollment drops, then your FTSE payment will drop. But if it goes up higher, it doesn't go above that line. So we've grown 3% since that happened, but with no additional revenue. So we need to relook at our scholarship situation and say, is it paying us to encourage people to come here at the same rate or at a growing rate when we're not making any more money for them coming? Whereas if they pay tuition, at least we would get that revenue. In fact, we're looking at things like how do we expand our online presence out of state, because out of state students pay the equivalent of the FTSE amount plus tuition amount. That's why out of state tuition is so high. You know, can we reach another couple hundred students that are out of state through online courses? That would significantly impact because we'd be getting that state aid portion paid for by the student, especially out of state students who have some sort of tuition assistance. That's our target right now. So military. Can we reach out to military that say we're here once and say, hey, finish what you started at EAC through EAC Online? That's where we're looking. Well, that's where I'm looking and trying to twist some people's arms to get them to look there. I think it's a market. We just got something called SARA certification, which allows us to offer our classes in any state, which we didn't have. We just got that this year for that purpose, so we can branch out. Anyway, okay. So here's the differential analysis, expected increase in revenue, if your revenue goes up, then your variable costs will go up, which will give you an expected increase in operating income. Why do we not consider in our differential analysis fixed costs? Because fixed costs are fixed and they don't change. And in differential analysis, we're only looking at what would be different with the special pricing, okay? So here's their flow chart. If the expected increase in revenues exceeds the expected increase in variable and fixed costs, you accept it. And if it's less than it, you reject it. Again, thank you for that. You know, so if it's going to make you money, you do it. If it's not going to make you money, you don't. And as dumb as that sounds, you would be surprised. Mostly people take on these special orders, especially in small business, not understanding the true costs of it. They don't sit down and do an analysis of those costs. There are sometimes additional fixed type costs. Like if I take on this special order, I'm going to need to buy a special tool because they want some sort of special tooling on their, you know, what I'm making for them or whatever. And, you know, that's kind of a one-time cost you have to price in, right? Okay. So deciding which product to sell, again, usually they just guess. What they should be doing is saying, what is the profitability or the segment margin of each of these product segments? And what is the potential volume for each of these segments? And trying to push the ones that have the better margin, right? So here's some questions to ask. Does the product or segment provide a positive contribution to margin? Will the fixed costs continue to exist even if I drop the product segment? Because sometimes they'll think if I drop this, it'll save me tons of money, but it's based on some huge fixed cost that's not going to change even if they drop it, right? Especially if they're allocating, say, something like, you know, a building. So they're allocating the cost of that, or allocating their rent to that product margin, or, you know, well, when that product margin goes away, that rent is still there, right? Unless you can somehow change it. Are there any direct fixed costs that can be avoided if the company drops the product segment? Will dropping the segment affect sales of their other products? And if they did drop it, what would they do with the free manufacturing capacity? Would they be able to make more of the higher margin item? So that's the sort of things you have to think of when deciding whether or not to keep or drop an unprofitable segment. So here they have their income statement done by product. You can say they have standard tablets and premium tablets. The standard tablets bring in a lot more revenue. In fact, what's the operating income on the premium tablets? They're losing money. So it might look like a no-brainer to just drop that segment, right? We're losing money on it. But let's look at some things. They have a fixed manufacturing cost of $70,000. So they have a total fixed manufacturing cost of $180,000. I don't know how they split that up. It's fixed, so they had to allocate it somehow, just decide this much goes to this department, this much goes to this department or this product segment. Well, this one's barely paying more than half, even though its revenue is 5 times what the other one is. Sometimes you have an allocation issue, and these fixed costs won't go away if you drop the premium tablet line. They're fixed costs. Selling and administrative, that might go away, even though it's fixed, if you're going to lay off the people. Colleges are notorious for that. They'll try to save money. They'll shut down a program, but because they don't want to hurt people and take away their jobs, they find another job for them there at the college. So now not only did they lose whatever revenue that program was creating, but they didn't get rid of the expenses of that program. So now they're losing more money because they're thinking like teachers instead of thinking like business people, right? It depends. We have some, like our executive vice president is very sharp financially. I'm not trying to dog him at all. He's very, very smart. So fixed costs remain unchanged. Sometimes over the long term, like when we get rid of that piece of equipment or something and all the maintenance on it or whatever, but allocated fixed costs are irrelevant because they're allocated. You can't really say that those are a part of that segment. They're just allocated to that segment. They're still going to be there whether or not you get rid of it. Relevant fixed costs include things like things that will go away if we get rid of the product segment. So here's a differential analysis. When the fixed costs won't change, their expected decrease in revenue by getting rid of the premium tablets, their expected decrease in variable costs. So getting rid of that money-losing product segment would actually lose them $90,000 a year. So even though it seemed obvious at first, it wasn't, and that was because of the fixed cost issue. There were fixed costs that weren't going to change. If you have a scenario where some of the fixed costs will change, so now we'll have the expected decrease in revenue, expected decrease in total variable costs, expected decrease in fixed costs. So in that case, they would actually be ahead by getting rid of the product segment. So you understand now, so imagine in real life, imagine this college trying to decide whether to get rid of a department or a division or a program. How many moving parts there are and how difficult it would be to really understand all the costs. If we got rid of football, people are like, that's a no-brainer. It costs tons of money. It brings almost nothing to the school revenue-wise because most of those students are on scholarship and they're living in the dorms and they're right. But then you have to think, well, okay, but a portion of what we pay Sodexo for them to have a meal card actually comes back to the school. So some small portion of it, because there's a revenue sharing arrangement between the chow hall and the school. Okay. If they're on scholarship but they're Pell eligible, then the school gets to capture their Pell. So there's revenue coming in that sense, maybe up to like $4,000 a year. So the true cost of the program might be less than what it looks like when you just look at the costs, because you'll be offsetting some revenue too by getting rid of it. Would it save the school a bunch of money still if there was no football? The answer is yes. It's a very expensive program. But that's a decision, right? With Maricopa's programs drying up, they got rid of football. Then they found a funder to fund it for 3 years. So now, does that mean we have to look at ours and say, does it pay us? If you ever go out to a football game, you'll see students and about 30 people from the community. And you almost want to say, hey, if this is so important to the community, can we self-fund this? Is the community willing to donate enough to keep the program running or pay half of it? But we'll see, right? I'm sure when the new president comes in, there's going to be an analysis of every single program. There has to be. to see where we are financially, what we can get rid of, what we can't, what we should and what we shouldn't. There's other considerations, like maybe it would save us money, but might it hurt other product sales if we get rid of it, things like that. So there's their decision rule. If the lost revenues exceed the total cost savings, don't drop it. If the lost revenues are less than the total cost savings, drop it. In other words, if it makes you money, keep it. If it's not making you money, lose it, right? Or if getting rid of it will do that. Product mix, same idea. We don't have unlimited resources. We can only make so much of each of our products. So what you do is you calculate the contribution margin per unit. Remember, contribution margin is revenue less variable expenses. So that's the amount that the product you're selling is contributing toward paying off fixed expenses. Okay? A negative contribution margin means that your variable costs are higher than what you're selling it for. That's bad. But any positive contribution margin is a good thing. It's because that means it's covering some of the fixed expenses. So you can see here that the premium tablet actually has a higher contribution margin per tablet. So what do we emphasize? We emphasize the product with the highest contribution margin per unit. So in this case, maybe the only reason premium tablets weren't looking good on paper before is because they had been allocated such a high portion of the fixed costs, because at the variable level, they actually make more money per tablet. So if we can sell more of them, we'll be better off. Sometimes you have to consider some other things, though, like if it takes 7.5 hours to make a standard tablet and 10 hours to make a premium tablet, you could figure out that that's tablets produced per hour, or actually not tablets produced per hour, but that's confusing. Tablets produced per hour over 1, which means, I don't know what it means. Anyway, if we take our contribution margin per tablet and we multiply that by their rate they've made here, which I think is confusing, you find out that actually per hour of machine time or direct labor hour, that the standard tablet actually makes more. So if you're so what they're trying to get at here, and I think they did it in a really confusing way on the slide, is you have to figure out what your constraint is. If your constraint is the number of labor hours you have, then you would need to figure out which of these products generates the most contribution margin per labor hour. If your constraint is something else, physical space in the factory, then you figure out for the level of my constraint, the thing that is keeping me from just producing an unlimited number of these things, which thing is making me the most money per unit of constraint. Does that make sense? Because then you can focus your efforts on making the thing that makes you the most money. Why does the mine run 24/7? Because time is their biggest constraint. So the more they can crush rock into powder and dissolve it and extrude the copper out of it, the better. So not only are they working 24 hours to keep that working all the time, they're looking at processes that will make that more efficient so that they can get more copper out per hour, right? Time's usually the big constraint. Labor hours, that's where we're always limited. Why do people make bigger factory equipment? Because it lets you move more stuff through the factory per hour. Why do they use huge haul trucks at the mine? Because it lets them haul more ore. And so for any hour of processing, they can get more copper. So that's all confusing to me, the way they said that. But really what they're saying is you have to look at the constraint and consider contribution margin per constraint. So now you say, look, at $25.66 per hour on the standard tablet, if we have 19,500 hours, we're making 500,000. With the premium, we're making 438. So even though we're making more contribution margin per tablet on the premium tablet, we're making more contribution margin per hour on the standard tablet because it takes fewer hours to produce those tablets. Okay. So sometimes then what you have to do is find the right balance. And that's what they're doing. All right. Sales mix. Sometimes we also have, if we're a merchandiser, if we sell stuff, we also have those type of constraints. So we have to choose which products we're going to push. They say display, what we're going to try to sell more than others. Sometimes places like Walmart, they have space constraints, right? How much shelf space is there and what product do we want to put on what part of shelf space? Not all shelf space is the same. The highest margin products in the store, usually by the checkouts. So they make pretty good money on a candy bar. You put them right there so that you'll grab them as you go out. Okay. And actually, the sellers of those products will pay a premium to Walmart to have their products put right there on the cash register because they move more volume there. End caps, when you come around the end, those sell more than regular shelving. Okay. So all those constraints mean you have to know how you want to mix it. So again, same idea, contribution margin and display space constraint. If they make $8.40 on hardcover books and $40 on paperback books, but you can only put 10 hardcover books in a foot of display case where you can put 20 paperback books, it might look like the hardcover is a better deal, but if your limiter is display space, then the paperback book actually makes you more money per foot of display space. I have that with my storage, where I have different size storages, and the smaller units that only go for $30 a month actually make me more money per square foot than the big units. Because $30 for a 5x5, a 5x10, which is 50 square feet, is actually more money per square foot than $70 for a 10x20, 200 square feet. Okay, and so again, I try to push the smaller units first, keep those filled, because my constraint is space. All right, and then outsourcing versus process further decisions. Should the company outsource a component of the finished product or make it themselves? And should a company sell a product as it is or process it further? Again, depends on your capacity and what the costs are. How much do the variable costs compare to the outsourcing cost? Are there any fixed costs that are avoidable if we outsource? And what could we do with the freed up manufacturing capacity if we outsource this? Could we do something over here that would make us more money? So here they're doing an outsourcing decision. They're going to make some casings or outsource the casings. So think of a problem that would give you the direct materials cost, the direct labor cost, the variable overhead. So there's your total cost of making the casings versus if you could just hire a firm to do it. Well, hiring the firm is $50,000. Maybe in the college it might be like, should we have our own campus police or should we just go to Town of Thatcher and contract for them to provide security for the campus? They'd have to look at the costs of both, right? That's all. If the fixed costs will change, though, it might be different. So now they have their direct materials, direct labor variable. They also have a fixed cost if they make. So now it's closer, but it still looks like it's probably a better deal to make their own. If the differential costs exceed the differential cost, so the costs of making exceed the cost of outsourcing, then we outsource it. If the costs of making the product are less than outsourcing, then we don't outsource it. Again, that part's not rocket science to me. I think it's interesting that they make this big show of it. So here's an example. 3 alternatives to consider. Do we use their facilities to make the casing, buy the casings and leave the facilities idle, or buy the casings and use the facilities to make a new product? So now they take the expected cost from making it, from outsourcing it and leaving it idle, or outsourcing it and making a new product. Then they can subtract out expected profit from the new product. And now it looks like outsourcing might make sense if they could actually use the space they were saving to make something else and make a profit on it. Okay? Again, in real life, they make this sound so easy, and in the problems, they'll be pretty cut and dry. In real life, there's tons of moving parts there. In other words, there's tons of how if I change this, it's not going to just affect this, it's going to affect lots of stuff. Right? If we got rid of our nursing program, that wouldn't just affect nursing, it would affect all the students who come here pre-nursing, and then after a semester of pre-nursing decide nursing's not for me and they go into another thing and then suddenly they're business majors or something else. it would impact more than just the nursing program. And it would be almost impossible to fully estimate all of the potential costs of dropping that program. And that's how it is in real life. This is hard stuff. And then one more concept, sell or process further, which is like, do I sell this product now or do I process it further, like I talked about with the Vlasic pickles? How much revenue will I receive if I sell it as it is? How much revenue will I receive if I sell it after it's been processed further? And what are the costs of processing it further? Those are the things to consider. So again, you do a differential analysis. You say, here's my expected revenue if I just sell it. Here's my expected revenue if I sell it processed further. You can see that increased the revenue. Here's the additional costs of processing. So in this case, it's better to process it further. You're going to make more money than you would have by just selling it as it is. In other words, whether we sell a as-is product or a processed further product, there's going to be joint costs. The cost of getting it to the point of the first sale, the first decision point. Do we sell it here or do we process it further? And then there'll be additional costs, the cost of processing it further. That's all they're saying there. And the decision rule, if the additional revenue from processing further exceeds the additional cost, then you process it further. And if it doesn't, then you don't. All right. Sorry, that took a little longer because we had that hold up with the slide and I got talking about college stuff. But this chapter, I hope it didn't seem too hard. It won't be too bad. I promise you. You'll get into it. And I think most of it's common sense. Okay. Where it gets confusing sometimes is like when it doesn't give you straight answers and it expects you to sort of guess. It's not really guess, but it expects you to make this decision on which of these costs apply and which of them don't. But that's part of what you're having to do, right? Is to look at it and say, these ones are relevant, these ones are not relevant. That's the hardest part of the chapter. All right, guys, have a great day.